Hey everyone, Mr. Tweet here. So in this video, I'm going to be going over bank balance sheets and how banks create money. So typically what you'll see here on one of these kind of questions that deal with bank balance sheets is you'll see something set up with assets on one side and liabilities on the other. Assets are things that are owed to you or things that you have of value. Liabilities are things that you owe to someone else, right? So this is from the bank's point of view, not from you as the customer of the bank's point of view. So a couple things you need to know. First of all, you have to remember that we have required reserves, that whenever you put money into the bank has to hold on to a certain percentage of that money, and then they're free to do what they want with the rest of it. They still owe you the money, but they're free to buy bonds or make loans or whatever they want to do with that other portion of the money in general. There's obviously lots of rules, regulations, but as far as kind of our simplified econ example goes, it's going to be, they have to take out required reserves, and then after that, they can kind of do, what they want. So if you go to let's say you're going to put some money into your bank account, right? That's a liability for the bank. What's happening there is you're going to the bank and you're saying, here's $1,000, for instance, right? Here's $1,000. The bank owes you that $1,000. You may think of it as like my $1,000 is sitting in the bank and I have access to it whenever I want. And that's mostly true. But the reality is that when you go and you deposit your money into the bank, you're giving them $1,000. They owe you $1,000, right? We use DD to show that money is a deposit that can be due on demand. That whenever you want, you can get it back. So DD is demand deposits or deposits due on demand. So you've got $1,000. Our balance sheet always has to balance. So that means over here on the assets side, you're going to see something like, first our reserves have to be taken out. So they're going to take $100 of that 1,000, and that goes into required reserves. That could either be like, they could either put it like actually in the vault at the bank. More likely, they have it on deposit with the Federal Reserve, the Bank of Banks. So they deposit that $100 with the Fed and say, hey, that's our required reserves because we have $1,000 of demand deposits. Whatever they have left over, in this case, 900, that's called excess reserves. That's extra money the bank can decide what they want to do with it. They can hold on to it and they can keep it so that they have like extra reserves to be extra safe. They can take that money and they can loan it out. So when they make a loan, then they can collect interest on that and they can make some profit, right? So maybe what they decide to do is maybe they want to hold on to $400 of excess reserves, and then they can make a loan for $500, right? Notice that it still balances. Notice also the $500 loan, that money is not at the bank. They loaned that money out to somebody, but it's owed to them. So that's why it's an asset, because they're owed that $500. So what this bank right here, we're looking at right now, like what's going on with this bank? They owe a customer $1,000. They have $500 in the bank, 100 they're required to keep, 400 of excess money that they can do what they want with, and then they've loaned out $500 to someone else that's owed to them. So like if I walked in this bank right now and I wanted to get a loan, they could loan me up to $400. They can't loan me this because it's already been loaned to someone else. They can't loan me this because they're not supposed to. They're supposed to hold on to that. Now, technically, they could loan it to me and then they could just get like a loan from another bank to cover the required reserves. That's the federal funds rate thing. But, simplified, they've got to hold on to that. I could get $400 worth of loans from this bank right now. So something else that they might do is instead of making a loan, they might buy a bond. Remember that a bond is basically like a loan. So what's happened is this bank has bought this $500 bond. It's not cash. They have a piece of paper sitting in the bank that says whoever holds this piece of paper is owed $500 at some point in the future. And then they collect interest in it, which becomes profit for the bank. But so that's another option for them. They can't loan out a bond. They can't give out a bond because, right, if you went to the bank and you're like, I want my money back out of my $1,000, right? They can't give it to you. They can't say like, oh, well, here's a $500 bond and here's $500 in cash. You're gonna be like, hell no, I want my $1,000 in cash right now. I want to go spend it. So this bond is sitting there. If they had to, they could sell it to get the cash that they needed to pay off their customers. And again, this is a way simplified example. But let's say that this person decides to come, that's deposited $1,000. Let's say that they decide to come back to that bank later and that they want $100 out of their account, right? So we're going to subtract $100 coming out of that demand deposit. So now the bank only owes $900 to you. They're going to give you $100 cash, but we got to take $100 off this side over here as well, right? So what's the new required reserve? What's the new excess reserves? Well, the first thing that you might do is you might say like, oh, well, we can just give them $100 of excess reserves and we're good. That's true. You give them $100 of excess reserves, we're good. However, we're no longer balanced. And the reason why we're no longer balanced is because on this side, I have 900 of demand deposits. I've got 100 on excess reserves over here, but I only need 10%. That's what this up here, my reserve requirement tells me. I only need 10% to be held in reserves. So we have to adjust this. This $100 required reserves, I'm going to turn that into 90 required reserves and 10 excess reserves. So now we're balanced because I've got 90 required reserves over here, 900 demand deposits over there, which means that this bank right now, I can combine all my excess reserves. They have 310 excess reserves available. So if you walk into this bank right now and you wanted to get a loan, you could get a loan for 310 because that's what they have available to loan out. That's their excess reserves. All right. So that's bank balance sheets. As you're going to be working with this, I know it's going to be a little frustrating, a little hard at first, but that's kind of how bank balance sheets work. Now, the assignment I gave you gives you a series of questions that are intended to kind of like help you learn these things one step at a time. But I also have a table here to kind of show you like the big picture. So let's fill out this table together so you get an idea of how banks actually create money. Because what happens is when you take your money and you put it into that bank, right, and then they loan it out, the person that they loan the money to, they're getting a loan to spend. They're buying a car or a house, or they're using a credit card to buy clothes and food or whatever. But they're buying stuff with that loan. Well, when you get paid with that loan, that's money. You're not seeing that like that to you is money. And in fact, you might take that money and go put it into your bank. So one of the things that we see is that banks actually create more money than the government. That when people put money into the banks and banks make loans and then that money gets spent and then people put that money in the bank and then they loan it out and it gets spent and it gets deposited and loaned and spent. And once that cycle keeps going, banks create a tremendous amount of money. Now, on the flip side of all of that are loans, that the way that banks create money is by also creating loans. But banks create a tremendous amount of money in our economy. It's important for us to understand this because monetary policy depends on us adjusting the quantity of money in the economy. So let's go through some questions here and I'll answer these with you. You guys can fill out your charts there at home. So first of all, the first column here, I know it's kind of hard to see up here, but you should have your chart down there. You deposit $500 into your bank. All right. So let's look and see what happens. So first of all, if you deposit $500, what happens to bank reserves? Well, if you put $500 into the bank, the bank has to put 10% of that in required reserves. So what we see here is that when you deposit $500 in the bank, that the bank's reserve requirement is going to go up by $50. Now, the second question here, right? I'll use a different color for this one. The second question here says the Fed buys a bond from Rick, $500 bond, and then Rick deposits the $500 bond into his account. So the Fed's buying this bond from Rick. So this is $500 coming into the economy that wasn't here before. Rick sells his bond. Rick is depositing his bond in the bank. The bank says, all right, $50 required reserves that they have to take out of his loan. And the bank now has the other $450 to do what they want with. Over here, if the Fed buys a bond from the bank, there is no change to excess reserves. I'm sorry, to required reserves. There is no change to required reserves. That because, you know, the banks can only buy bonds with their excess reserves, there's no change to required reserves. Now, if we want to look and see what would happen to excess reserves, right? Well, from your $500 deposit, that $500 deposit, 50 went into required reserves. The leftover 450, that's excess reserves. Same thing with the deposit that Rick made. It's going to lead to 450 excess reserves. With the Fed over here and the Fed buying the bond from the bank, banks can only buy bonds with excess reserves. So that means the whole $500 goes back to excess reserves. So we're already seeing a little difference here between when the Fed buys a bond from a bank versus when it buys it from just a person like Rick or whoever, right? So that's what happens to reserves. Also, you could add those up for total reserves. So like total reserves 500, total reserves 500, total reserves 500. But you know, I'm not going to get too much into total reserves. Number two, what's the largest loan that you can now get from this bank? So remember, banks can only loan excess reserves. So the answer to this one from your deposit is that you can get a loan for $450. Over here, when Rick deposits the 500 and somebody wants to go get a loan, again, there's 450 excess reserves, which means you could get a loan for $450. And then over here, we could get a loan for $500. So we could get a $500 loan. Oops, I should have used a different color there. It's kind of hard to tell on that video anyways, but anyways. All right. The largest loan available is a $500 loan. Notice how the next question says the max increase in loans from the banking system. That means that, right, somebody gets a loan for $450 and then it gets spent and it gets deposited, and when the 450 get deposited, 45 are going to be put in required reserves and $405 are available to be loaned, and then the 405 is going to be spent and it's going to be deposited. When we see the phrase the banking system, then that means that we're going to see a multiplying effect happening here. And so if we want to know the max increase in loans of the banking system, for this one right here, we're going to use our multiplier equation. X equals 1 over the reserve requirement, which is 10%, times the amount of the first loan that would be made, which is 450. So we get 10 times 450, which equals 4,500 as our answer. Now, you're going to get the same answer for this one right here because it's the same amount that's going to be multiplied. The 450, whether it's, you know, from your deposit or Rick's deposit, you're going to end up with the same answer for this one right here, $4,500 created by the banking system. $4,500 in loans created by the banking system. Over here, we're going to use the same equation. X equals 1 over 0.1, but the first loan is going to be for $500. So we would end up with $5,000 worth of loans being created. So for 4,500, 4,500, $5,000 worth of loans being created right here. So the next question is, what is the maximum increase in money created by the banking system? So when a bank makes a loan, it's creating money. So what we're going to see here is that if the bank can loan out, if the banking system altogether can loan out $4,500, we're going to see the banking system is creating $4,500 of money in our economy. Right, 4,500. Over here, the banking system is going to create $5,000 of money from those loans. Next question. How much money, how much money was created directly by the Fed? So for this question here, for number one, the Fed didn't do anything. So we're going to get a big fat 0 for that one, right? Fed didn't do anything. For the second one here, right? The Fed buys the bond from Rick. He deposits it into his account, right? The Fed, when they gave that $500 to Rick and Rick deposited it, deposits count as M1. So that for here, the Fed, by giving that $500 to Rick, they added $500 to the economy by buying that bond from Rick. Over here, the Fed, by buying the bond from the bank, no money was created because excess reserves do not count as M1. It's only cash or checking account deposits. So because that was originally excess reserves and not a deposit, it doesn't count for money created by the Fed. So we've got no money created by the Fed, no money created by the Fed. Over here, the Fed created $500 because they bought the bond from Rick, $500 of M1. Last question. What is the maximum change to the money supply due to the Fed action, right? Well, the Fed didn't really do anything here. So this one is really not applicable, doesn't apply. So we're going to put NA for that one. It doesn't really apply because the Fed didn't do anything. But what I want to show you over here was the Fed action. It created $4,500 of money out of loans, and it created $500 new dollars that went to Rick. So the answer here is the Fed created $5,000 total, right? M1 increases by $5,000. Over here, right, $5,000 of money was created by loans. $0 was created directly by the Fed. And so we end up with how much did the Fed create total in total? 5,000. So what we see, right, there's a few lessons here. One of the things that we see is that the Fed, whether they buy their bond from Rick or they buy it from a bank, it affects the money supply the same. And it's the same thing when the Fed, whether it buys a bond or if it sells a bond, it takes money out of the money supply at the same rate, whether it's from Rick or from a bank, it has the same effect. Ultimately, it's just slightly different steps to get there. So, anyways, I know it's a lot. The first half of this, we kind of went over bank balance sheets and how bank balance sheets work. And then in this section, we showed how the multiplier works in there as well. That when we're looking at like the amount of loans, being created, that we use the multiplier. When we see the phrase banking system, that means that we're using the multiplier to calculate, what we're doing, what's being created there. If it says just this bank, then we're not using the multiplier. We're only looking at what that bank has available to loan out, right? As far as how much loans they can do or how much money that that bank can create, it's only their excess reserves that they can create loans from or they can create money from. If it's the banking system, we'd look at whatever the available excess reserves are and then use the multiplier to figure out what's the maximum amount that could be loaned and what's the maximum money that could be created by that. So, long video. I know that we went over a lot of stuff quickly here. The packet that I have for you is supposed to kind of go through this step by step to help you. You may want to even check this video out after you go through the whole packet, and then it might make more sense the second time as well. So hope this helps. See you guys in class. Peace.